Well, good morning, everyone, and such a pleasure to be here again. It's become an annual event, and I thank Lourdes for the invitation. And it's wonderful to be with so many colleagues from the industry, who I don't get to see that often. So the first thing that I'm often asked is, how is Trump making decisions? What are his key objectives? What has it meant for the U.S. and the rest of the world? So I'm going to just spend a few minutes going through some quick thoughts on this. So many people say, well, look, Trump is just freelancing. He changes his mind all of the time. It's totally unpredictable. And I would argue that he's actually been extremely clear on what his objectives are. So what are those objectives? And if you look at his decisions, they really fit under these three categories. First, to increase CapEx, to generate higher growth and productivity. And that's making the tax cuts permanent, the business expensing that we saw in the One Big Beautiful Bill, and the focus on deregulation. The second point is reindustrialization and reshoring, which includes the tariffs. They often say the tariffs are an incentive to reshore and that they are an up the iceberg where the revenue will go down and you should be incentivized to actually relocate to the United States with an objective not just to bring capital to the U.S., but also to bring manufacturing jobs and create jobs in the U.S. And the third is national security. It is the autonomy, the strategic autonomy, and securing resources for competitive technology, including energy supply and making energy prices lower. Now, if we take a look at just what Trump campaigned on, he made a number of promises, which this slide is not showing up, but many of those promises, which people thought he would not deliver on, he actually has kept. And if you look at the Republicans, they actually give them a 93% approval rating, whereas the Democrats give him only a 2% approval rating. And I mention this because such polarization has meant that it's very hard to read the sentiment indicators. When it's 93% of one side that approves and 2% of another side that approves, this 40% average really is a hard one to tell you the story. What we've seen across the board is a market rally, though. And I think the good news from emerging markets is that this is the first time in years where it is actually outperforming in the financial markets, even though the U.S. has done very well, and also that we see flows returning. And the story has been one that it's more than just resilient. EM countries for many years had no choice. They followed more responsible policies. Lower fiscal deficits than many of the developed market countries now, positive inflows returning, and in a period where we're all worried about asset bubbles, the valuations are more attractive right now. And so I think we're in a world now of very easy financial conditions. If capital is easily available, it's made it very hard to find market inefficiencies. Everything is fully priced. We're in a world now where investors are going to really have to do singles and doubles rather than home runs. And emerging markets really does fit in as a single and a double for what it offers right now. We still have policy support coming from the central banks, policy rates that will be coming down. I hosted the St. Louis Fed yesterday, and they really made the case, as did Beth Hammond at the Cleveland Fed, that we're pretty much at neutral rates now. There's not much room to cut rates in the U.S. right now, but EM still has that space. But I wanted to talk about just the capital flows and the trading patterns, because we have not seen de-globalization or de-dollarization when we look at the overall numbers, but we have seen a true shift in the trading and investment patterns. So first of all, EM's dependency on China has only increased. You take a look at this map, there's 130 countries that trade more with China than the United States. So if the U.S. really wants to trade more with China, there's no doubt who's going to win, which is one reason why you've seen the rhetoric change from the Trump administration. But the trade flows we have seen have been shifting. But the first thing I would say is, why did the tariffs not make such a big difference in the economic outlook? Well, you have these offsets in fiscal spending, but also the tariff rate that's been observed has been much lower than what they're trying to achieve. The tariff rate now has gone from 2.4 to about 10% observed, probably 16 to 18%, which is the effective rate, but they haven't been able to implement this that quickly, and the Supreme Court looks, in my opinion, like they will rule the use of emergency powers as illegal. The other thing I would say is that there have been a lot of exemptions. So if you take a look at Brazil, 42% of exports are exempted. 700 exemptions. USMCA is 85% of exports. So we have not seen the devastating impact that many people thought would occur from the tariffs. But we've seen this big shift in trading patterns. That's where we've seen actually some very significant changes. So China's share of GDP has not gone down. We're not seeing de-globalization, but we're seeing a huge decline in the exports to the U.S. and a big increase to the emerging markets countries. And you can really see that in the charts here. You can also see, though, that for FDI flows, the U.S. still is the dominant actor for Latin America. Remittances are still from the United States as well. But what we are seeing is that the emerging markets dependency in China has become even greater at this stage. And we can also see that public opinion has been changing. There are now more countries in the world that look at China favorably compared to the United States. If you look at the latest data that comes out of the Pew Research Center, and there's far more concerns now if you look at how the world is looking at global risks on false information online that wasn't even a category a couple of years ago, and also on just the global economic risk and uncertainty that this has generated, and less faith in United States institutions here. So, has Trump been able to get money to return to the U.S.? Well, a lot of people say, how do you track the Trump numbers? So this is what's on the White House website. With each trade agreement, he has actually asked for investment flows. So he reports $8.8 trillion. I'm sorry, some of these charts are not coming up that clearly. Now, I showed this to somebody at the White House. They're like, oh, no, Joyce, that's wrong. It's $19 trillion. I said, oh, of course, 80% of U.S. GDP has come in 10 months of the year. How could I be so far off on my estimate? And also, it's what you have posted on the White House website. But let's try to break this down in a more granular way. What we have seen is that if you look at the U.S. Investment overseas, it's actually down 14% in the first half of the year compared to the first half of 2024. So it's a 14% decline. If you look at investment flows coming into the U.S. in the first half of the year, including from Latin America, the emerging markets countries, except for China, I mean, if you look at advanced Asia, it's up about 100%. That number is about 400 billion. It's not the 1.2 trillion you're hearing from the Trump administration. And that is like a move that's from like 250 to 400, 200 to 400 billion. So it's a 100% increase. It's not 8.8 trillion. It's not 19 trillion. It's not 1.2 trillion. But we are seeing that the flows are coming to the U.S. from emerging markets. And in emerging markets, we have not seen an increase in the FDI flows since about 2022. So there is a trick. The real point I would make is it hasn't been devastating for growth. It hasn't been devastating for the overall economic macro performance, but a real shift in the trade and investment patterns. Everybody has to talk a little bit about AI. So AI is one where, is this just the U.S.-China story? Does it leave out the rest of emerging markets? Well, AI is the story. Just the Mag 7 alone, self-funded and not leveraged, are investing $700 billion a year in AI business investing. We estimate that AI accounted for 1/3 of global growth in the first half of this year, just the business investment. Not talking about productivity, just the inflows that are going in. And so as much as we are really happy that inflows have come back into emerging markets, we think they're about 20 billion year to date. It's 700 billion just to the Mag 7. But we do look at just where is emerging markets positioned in this AI race. It's U.S., China, no doubt, but the Middle East is also attractive for the data centers. Brazil actually also is one that stands out. Now, how will this end up between the U.S. and China on AI? And I would just say that, look, so much of the U.S. story has been asset reflation. So if you look at the trade flows, China wins. If you look at the asset reflation story, much of that being housing appreciation, asset appreciation in the U.S. wins over China. So which world are we living in now? When we look at the real economy versus just financial market flows, easy financial conditions, and such strong market performance. And we do see in Latin America, because there's a lot of focus on Latin America, that there is an opportunity for Brazil in particular that stands out on the data centers. So just a few quick thoughts to start off this conversation on things that have been top of mind all year. What have the Trump policies meant? Have we seen a change in the trade and investment flows? And where's emerging markets with respect to the AI story? Thank you very much.
And you first. So, with all of that being said, and a lot has been said, my first question would be to the rest of the panel. What have you guys felt have been the most pressing macro trends over the last year? And how has that most affected emerging markets?
Anyone in general?
Yeah.
Yes.
Alberto, any votes?
Sure, yeah, absolutely. Hi, good morning, everybody, and having a happy 15th anniversary, and it's quite an achievement and a milestone. So kudos to the brains and energy behind this differentiated project. It's a pleasure to be here. Short and sweet, the presentation of Joyce, I totally agree. I mean, it's basically factual, it's data. I have not much to add to that characterization. I fully agree. We're not seeing de-globalization. We're not seeing de-dollarization, but we see a different pattern of allocation of the marginal dollar and the marginal dollar of trade, the marginal dollar of investment is, reshaping the global economy. We're super bullish on AI as well. We think it's truly transformational. There are two angles to it. One is, the private investment and the return on that investment. The other one is the broad spillovers into the broader economy and the productivity growth that will come on the tail of it. I think it's an opportunity for EM. I'm not sure if LATAM will be such a winner in that race. Brazil is big, Brazil is energy rich. Seems like a natural destination for data centers and infrastructure associated with that. So we can see a moment of that. I just want to make a little bit of point. I cannot escape the fact that I'm a macroeconomist and the tariffs and the issue we have with tariffs. The objectives are pretty clear, and I'm gonna offer a positive view on it, not a normative view on it. Tariffs are basically a tax. Tariffs change relative prices, and by changing relative prices, they change the incentive structure. So if you want to bring activity, industry into the West, tariffs is one of the instruments. It may not be the most efficient one, but it is an instrument like many others that change the incentives and that has real sector environments. The problem has been twofold. Number one is the erratic implementation of tariff policy has been very heterogeneous. Some countries get a long straw, some countries get a short straw. The countries that get the short straw, that may change, within 3 to 4 weeks. So that creates a lot of uncertainty, which makes implementation quite difficult, which makes planning, particularly for multinational companies, where to integrate their supply chains also quite difficult. Right? So nothing seems to be particularly permanent. And when you look at the tariffs, and we do that meticulously, in my job, calculating the effective tariffs, and how is that impacting different countries and trade flows, it's quite difficult. It's a massive endeavor just of keeping those databases and keeping track of these tariffs. And on top of that, they are not permanent. They come and go. The second one is that we have one instrument pursuing multiple objectives. And that when that is the case, you run into inconsistencies because you may have tariffs to promote reindustrialization, homeshoring, issues of that nature. You may also use tariffs in order to raise fiscal revenue. You may call it incidental, but sometimes it's been often mentioned that tariffs are also an instrument to not necessarily consolidate the fiscal, but raise more revenue. You also use tariffs as an instrument to force action in other areas, Mexico in particular. You use the threat of tariffs in order to elicit more cooperation on the border protocols, on the flow of fentanyl into the U.S., on how the authorities are dealing with the drug cartels, or how the authorities in Mexico are dealing with China, on with Chinese investment in Mexico, and transshipment of Chinese goods from Mexico into the U.S. Sometimes you also use tariffs as political instruments, basically to somewhat punish people that you don't fancy. I think about the tariffs in Canada, for instance. So when you have like multiple objectives, things become a little bit fuzzy. I think it's perfectly natural to want to protect the industrial base in this world of geostrategic friction and fragmentation of the global economy. It's pretty clear that we see two spheres of influence forming, and this is not cyclical. This is part of like structure. This is going to be probably for the next 40 to 60 years. And the fragmentation of FDI, the fragmentation of the global economy, will have significant implications for global efficiency. Think about that globalization was a process of about 25 years where factory floor engineers were thinking hard every single day. What is the most efficient way to produce an automobile? Where should we produce that little trinket, that little part? And now, because of geostrategic reasons, because of home shoring, because of safe shoring, because of friendly shoring, because of having resilience to the supply chains, we are deviating from the efficient frontier. If you deviate from the efficient frontier, you pay a price for it. That productivity growth over the long term will suffer. And if we start to produce things in locations or in ways that are not the most efficient one, we'll pay the price. Basically, the prices will go up. Right? So this is like a very broad and dense topic. I was just touching at the tip of the iceberg and just the beginning of such a trend. But I think the next few years will be fascinating in terms of how the global economy reshapes. Let me stop it.
Yeah, thank you very much, Alberto. And it really makes me think a lot about when we're talking about geopolitical risk and risk of things like tariffs as a political instrument. Rohit, I would wonder if you have any thoughts on the avenues and opportunities that it creates for the non-traditional trade partners. When we're talking about usually all manufacturing come out of China, if all of a sudden we see a lot of tariffs on there, does that create opportunities for India? Does that create opportunities for other areas in Southeast Asia or Africa and so on? I'd love to get your ideas on that.
So first of all, thank you so much for the opportunity today. I'm a fundamental equity investor, so I believe that you're not buying into Brazil Inc. or China. You're actually investing in companies, these countries that we scour the world to identify where we believe capital will be respected, where we see businesses that are able to have a decent runway of opportunity, where they're generating good financial returns. And I've been fortunate to be able to do this for over 25 years. And well, my observation is that the emerging markets as an asset class is also taking. When I started out, I would argue that it was a monolithic asset class. You go travel the emerging world, you'd see the same consumer company, a bank, a telco, and you kind of had each of these countries covered. The world has changed. I mean, we are seeing parts of EM that are just starting in terms of foundational development, but then you've got other parts of the emerging markets that are driving the fourth industrialization and AI, and you see that in parts of North Asia. So when I'm looking around the world, I think what we're starting to realize is that this is not a convergence story. This is a story of hyper complexity. And when I kind of see that context, there are a lot of things that we're excited about. When I think about Latin America, I mean, as Joyce mentioned, rates are actually quite high. They show a lot of orthodox policies. We haven't seen a credit cycle really in the last decade. Rates at 15% in Brazil. If and when you start to see rates coming down, you see the development of a credit cycle. You go to a place like India, middle income levels today are around $2,500 per capita. About 20 years ago, that was under $500. When consumers get to $2,500, that's when you start to see the economy evolving more towards travel, home purchases. You start to see that sort of increase of that complexity. We're really excited about that middle class coming online. We think about China. One of the things that really stands out to us is that the ideology is different. I think you tend to find the group over the self. And one of the things that we are seeing, and be as an investor, many investors are saying, when is China going to announce a big stimulus? The savings rates really had. We don't think that's going to happen. Actually, we think that as long as the economy is growing around 5%, you're going to see more and more of a focus on next generation technologies, renewables, autonomous. Today, over 50% of all vehicles sold in China are EV in nature. Energy storage systems, battery technologies. These are some of the leading companies globally. You go to the Middle East, you're seeing a very healthy competition between the UAE and Saudi Arabia to transform their economies. So what I would describe is that this is the backdrop that it's no longer a unipolar world. It's all about complexity. But as an investor, that actually is starting to create real opportunities for great risk-adjusted rewards.
Absolutely. And I think the very interesting point on top of that is when you're talking about these credit cycles and how we're not seeing that sort of, or what the meaning of that credit cycle coming in could be. We're today looking at 75% of emerging markets expecting rate cuts in the next year. I know that's an expectation of rate cuts in the US. So Claudia, I'd love to get your perspective on this as well. When you're expecting such en masse rate cuts, what does that mean for the opportunities in emerging markets, and how does it affect the policy, or how does it affect you as an investor in fixed income?
Thank you, Carol, and thanks for the opportunity to be in here. It's a pleasure. I am a portfolio manager at Invesco, mainly emerging markets debt, fixed income in cross asset classes in the sense of local markets, hard currency. The rates and the effects decisions are separate. And I think it just first, if I may, a reaction to what my colleagues here were saying. It's very interesting to me that actually, the U.S. policy has been like a big driver this year, right? For us to think about how we can invest and driving this issue of the shifting trade patterns, investment patterns, as both Joyce and Alberto were mentioning. But it hasn't, so the impact of that in terms of stagflation outcomes or scenarios has not been exactly to the or yet to the extent that it was anticipated, right? And that's driving a lot of market optimism and very interesting, I think, valuations as well. And then it stands up the fact that EM resilience in emerging markets has been quite remarkable in this environment, right? So again, we're in an environment where there's a lot of policy uncertainty, which is hard to price. We're used to dealing with risks, but much less used to actually being able to price uncertainty under different outcomes. Yet emerging markets resilience in terms of the macro economics and in terms of market performance is a standout, right? And that's quite interesting to thinking about the short-term momentum and some of these more long-term structural issues that Alberto was also mentioning, right? Now, in terms of rate cuts and emerging markets doing rate cuts, right? I think the first thing that we have to admit is that there are certainly domestic drivers, and emerging markets are in a much better domestic equilibrium, macroeconomic equilibrium, to have some independence from the Fed and be able to optimize their business cycle and enact their mandate, right? How to conduct monetary policy in a way that you do have sustainable growth, that you have low inflation at the least output cost. At the same time, I have to say that Fed policy does cast a long shadow in this process. So we do think that there are some global drivers out there that are very important for central banks trying to understand or try to put together with their domestic circumstances how to enact conduct monetary policy. And they do have a lot of room to cut. But, the issue of Fed policy and the weakness in the US dollar is very, very important for emerging markets across asset classes, right? So that's a little bit of a big question there. We had a cycle of the US dollar in a real effective exchange rate terms that for the last 15 years has been, quite strong. And so now we're seeing the tip of that turning around, and there's a question mark out there how we're going to continue on which path we're going to go. But that's being very, very supportive for EM and for central banks as well, because it helps on inflation, it helps on their exchange rate depreciation risk that they usually, in emerging markets, it's usually a constraint in monetary policy. So there's definitely more autonomy right now, and I think more room to cut. But lastly, I'll finish with this. One thing that is not surprising in EM is that there is a lot of divergence. There's always a lot of divergence across countries, across regions. And so when we're talking about rate cuts, there are those that have more room, there are those that have less room, even if their real policy rates, are very, very high, which is the case in some countries, notably in Latin America. Brazil has very high real interest rates, Colombia as well, even Mexico to some extent, right? Although they are now finding the room to cut rates. And spreads, Mexico versus US are really at very compressed. So it's all very interesting. So I think bottom line, without going into specific stories, a lot of divergence. In general, EM's in a much better shape, and opportunities to invest. I'd agree with my colleague there, both on the equity side, on the EM debt side, especially local markets.
Just very briefly, just 1 minute, I totally agree. I'm not so sure we have a long route to cut. I think Claudia's point is right on the spot, that there's a lot of heterogeneity. Some countries have less room to cut because they're already at neutral. Some have more room to cut because the policy is too restrictive. The ones that have a lot to cut, I think it's still conditional on a baseline of further Fed cuts, and that we continue on a global environment of a weak dollar, that this weak dollar trend will continue. That has certainly facilitated the normalization of monetary cycles or easing monetary policy across the full spectrum of EM. But there's a very important point that Claudia touched, and I'm just going to take just a minute on that, is kind of this issue between risk versus uncertainty in the markets. As someone that has been in financial markets for quite a while, and my colleagues as well, financial markets are not afraid of risk. That's the bread and butter, what we do every day. Risk is not a problem. We know how to price risk, we know how to mitigate risk, we know how to hedge risk, we know how to slice and sell it. And so that's not a problem at all. That's the essence of the business. Uncertainty, totally corrosive. We panic with uncertainty. We don't know what to do with uncertainty, right? Risk is not a problem. It's like, if you tell me, that, I'm going to leave home on January the 2nd, and tell Alberto, you're going to do it this morning. January the 2nd, probably the temperature is going to be around 32 to 28. And it may snow or rain. So if I don't know anything else, I know the distribution of the weather for such a day. Usually I, leave home with a warm jacket and perhaps an umbrella. That's, I know the risk distribution of January 2nd. Now, if they tell me, Alberto, you're going to leave home today, but we don't know if it's winter or summer, the distribution of I don't know what to do. Shall I take a t-shirt or a warm jacket, right? So that kind of, gives you in very, clear terms that, the uncertainty we're seeing on a number of fronts, from the geopolitics, from the tariff regime, from protectionist policies, all that can potentially be corrosive and eventually even generate headwinds to harvest the opportunities that Rohit mentioned.
Yeah, and I think a lot of this also comes from, to sort of follow up on the context of the declining rates, a lot of this comes from the context that in the United States there was very low interest rates for many years, I think around a decade in 2010s, and through COVID, post-COVID 2021, we sort of see a large increase in rates. One of the larger, or one of the more interesting phenomenon that we've started finding is, despite US markets overperforming and emerging markets on top of that overperforming, we then have this underlying sense that bankruptcies within the United States are still increasing. The number of companies that are actually struggling to maintain their procedures are actually increasing every year, despite markets reaching all-time highs. So, Francesco, amongst the sort of credit landscape, and when we're seeing a lot of these companies actually struggling, what does that tell us about the underlying economic health of the US, and is our emerging markets in that same sort of space?
How much time do you have?
Look, it's really interesting because in the U.S., even in aggressive bull markets, and I'd argue we've been in the bull market since 2008 or post 2008, except for COVID. There's a little overlook there. There's always companies that run into trouble, and ultimately either file for bankruptcy or take other measures, shore up liquidity, extend maturities, etc. So I'll compare U.S. versus EM for a second, because I think in the U.S., there's been so much third-party capital raised, mostly private capital, whether it's credit, private equity, alternatives, etc., that the real default rate, and Joyce, correct me if I'm wrong here, but the real default rate is around 2%. But if you factor in what we call liability management, that rate is probably closer to 20%. Liability management is simply extending maturities, usually with an incremental capital to facilitate those transactions. So in the US, it's become very much a liability management market and fewer bankruptcies than historically. Now, what happens? Ultimately, 2 or 3 years, those maturities could wind up in a bankruptcy scenario. So it's like, well, why not just fast forward to the main event and just go to the bankruptcy and clean up the capital structure and things like that. But I think for now, just given the comfort of investors investing in the US, tons of capital chase these deals to the point where investors in the same capital structure are competing against each other to put capital to work. Contrast that with all of the cases I'm working on in Latin America, in Brazil, Mexico, Peru, Colombia. Most of those cases are going through court processes, local court processes, in some cases Chapter 11 in the US for a number of strategic reasons. For the most part, the companies we're talking to have tried to pull whatever levers internally to deal with, trade imbalances and tariffs and what's going to happen with rates. And for the most part, they're doing a good job. We haven't felt massive impacts from any of that. The cases I'm working on in Latin America all have idiosyncratic issues, nothing to do with tariffs or anything like that. They're all, project financing that went sideways or cases like that. And then last year, I remember speaking, I brought up a certain concern of mine, which has played out, unfortunately, in a couple of cases, which is fraud. And as much as you can price, January 2nd risk, you can't really price fraud. There's a couple of cases that you could look them up. I won't go into the names, but where cash was supposed to be in banks and the cash isn't there. So what happened? And these are big, sophisticated corporates. And so investors, in a case like that, secondary trading levels in the bonds would drop, and they did 60 points over the course of 2 days. So bonds that were trading at par basically dropped to 40 in 48 hours. So the point is, there's a lot going on in terms of, it just feels very frothy to me from a macro perspective. It feels a lot to me like 2005, 6, and 7, that big LBO boom before the GFC. That said, there's a lot of capital to buffer potential bumps in the night, as they say. But the takeaway, I think, is even in roaring bull markets with equities at all-time highs, there's always restructuring kind of work to do, or companies have overextended their balance sheets and not really thought about sort of 3 years from now. They're just kind of trying to fight to live another quarter in some cases, or another year. We're keeping a close eye because of the whole rate situation in Brazil. I think a lot of those companies, if rates don't go the other way, I think we're going to wind up in some kind of process.
Yeah, and Joyce, I'd love for you to also build on some of this. Is when we are trying to navigate this sort of, or maybe this sort of disconnect between equities markets doing extremely, extremely well, like Francesco mentioned in 2006, 7, 8. How do you then, as an investor, navigate whether or not you should be in that bull market and be participating and being very risk on, or whether or not these underlying macro factors are actually more of a concern than the equity market is internalizing?
Yeah. So what we are seeing is, if you look at the developed markets, sort of a disconnect between looking at what's happening with bond yields and what's happening with the equity market. Because there's more of a long-term focus on the fiscal debt and the debt sustainability. And that's showing up in, we've seen term premium in the US rise 150 basis points. This whole argument that we're actually at neutral rates now, there's not much room for the Fed to cut. So I think you are getting these long-term signals that are warning of some of the risk ahead with respect to the fiscal and the debt sustainability. And I think emerging markets are not in as dangerous a place that way. The deficits are higher than they were before the pandemic, but really from the first Trump administration, developed countries sort of blew out the fiscal deficit and the debt dynamics in 2017. So, but I think your question, the markets have rallied so much, everything looks like it's so fully priced right now. How are we looking at asset bubbles? The problem is that the inflection point is very hard to call. So you can look at 2026 and say, where we are in the AI investment cycle, it looks pretty clear that you're going to have a lot of CapEx going in. But then there's the whole question of when will we actually see the productivity gains? When will we actually see the return on investment? And you're even seeing just the intraday volatility with money so easily available, because it's not just the capital is available, it's customizable now. You can go to the private markets. There's the rise of the digital assets. And that's why I do think that in emerging markets, because you had 4 years of outflows, you have more competitive currencies, you have sort of still high interest rates in many countries. There are more opportunities, but you have to be pretty selective here. And so some of the themes that we look at are not even so much on countries or regions. I agree the market has changed. It's been like who is set up in some of the areas where we think there is growth and innovation, like the payment system, or looking at the data centers. Or looking specifically at the sectors where we think that they are a bit more insulated from some of the market volatility and have inflows that we can actually track coming in. Because if you can't track the productivity, you still can track the actual business investment that's going in. I think that we have also seen that if you look at where emerging markets have been positioned, still most investors are still underweight unless they're dedicated investors. So I actually think this is a moment for emerging markets that is going to continue to attract a lot of interest, even though you need to be selective here.
Hey, Cal, maybe I could add of course, a point to Joyce's. So up until about 6 months ago, as an equity investor in a forum like this, I would be looking.
Rohit, try and pick the microphone higher.
About that. I was going to say that about 6 months ago in a forum like this, I would be looking for the exit. People would come to us and saying, why do I need to bother with emerging markets? I'm getting 15% over the last 10 years in US equities. Emerging markets is giving me less than 5%. And I think what's important is sort of understanding where we are today in terms of that discussion around valuation. So emerging markets today represents less than 10% of global market capitalizations. United States is around 70%. On top of that, you think about where the starting point is around valuations themselves. So EM today, on average, again, this is why on average is also very dangerous, trades at about a 30% discount. The other thing that's I think is important is that if you think about the level of narrowness of the markets, emerging markets is not just an AI opportunity set. You do see sort of the opportunities in the financials and the deepening of the asset class. It's definitely not what it was 20 years ago when it was heavily materials and commodity centric, but you are seeing that natural evolution. I do think that today, from a risk reward context, understanding some of the comments from our colleagues, what has historically been a big headwind for emerging markets, which is strong dollar, is turning to be a little bit more of a tailwind. But ultimately, good governance, understanding company balance sheets, understanding that risk reward is you still need to do that work. And there, as an active manager, we see a lot of really exciting businesses to invest in.
Yeah, maybe I can say something as well for just because Joyce was mentioning the opportunity set for EM, right, and these differences in how flows are being driven. The issue of selective inflows or selective investment, right? And this divergence that we always see in emerging markets. What's essential, I think, these days, and very interesting to me, from a trained macroeconomist, the idea of credible policy frameworks that we are seeing. So it's not just a business cycle improvement in emerging markets, but there are some stories out there that could have structural components, and that's really very, very exciting, right? And just to leave Latin America for a second, I would highlight, for example, the changes going on in South Africa, for example, where there's a new coalition government, that hasn't happened in decades, where there is important reforms on the electricity sector, which is very constrained, logistics. As is the case with the EM, I mean, we always have to see how structural things are, but they're moving in that direction. There's a good story to tell. And that's really very interesting and assets respond to that, right? So we see the performance. And Nigeria is another one, right? Where also we see a very different type of fiscal and monetary policy with a very good technical team, at least. So etc. So I just wanted to make this point, to bring that up. Thanks.
And I think
Argentina. Yes, I was living in Argentina, or well, we do spend a lot of time in Argentina, but yes.
I think to sort of close on our panel, I think the main point that is common throughout all of our speakers today is that emerging markets have always been and still will always have opportunities. The question is now less about these generalized schemes of a specific region or generalized schemes of whatever type of country, and more in a case-by-case basis. It's not just that Latin America is going to have decreasing rates, therefore run into Latin America. It's what about Brazil's situation or Argentina's situation poses an interesting example. So with that being said, I think I'll have to close on our panel today. But thank you very much for our speakers.